Thank you for having me here. I will start, as is customary after a break, with the good news. So it doesn't necessarily sound like good news if you listen to the tone and the content of what I'm saying, but it's good news for people in this room, right? So depending on how you measure it, there's $200 trillion of assets under management, or 80 trillion. Let's stick with the lower estimate. There's 80 trillion of so-called long-term capital that you've heard about yesterday already, and that's pension funds, insurance firms, sovereign wealth funds, all with at least a theoretical long-term horizon of, let's say, 10 years or more. What is happening to these institutional investors now? I fear that they are facing an existential crisis fairly soon. So-called winter is coming to the world of asset management if you borrow from the Game of Thrones. Why is that? If you look at this present corpus of about $80 trillion, where does that money actually come from? Some, of course, came from your pension payments, right? I mean, every time you get paid, some of that money gets deducted for pensions. Some of it is insurance premiums. Some of it, as in Norway, is from the sale of oil and gas. So that is the original money that is put into the pot. Now, this money has been invested in financial markets for the past several decades, and that has generated a return. And these returns have often been reinvested. So if you look at the 80 trillion out there, if you break down where this has come from, some of it has come from these new payments, some of it has come from dividends on shares and returns on bonds that you have invested in, and some of it is capital gains. The fact that the Unilever share that you invested in 30 years back is now worth much, much, much more than it was before. And once you break that down, the largest component of this return, not your original money, is actually capital gains of this 80 trillion. Now, how has this capital gains come about? It's been a fantastic golden age for these long-term investors the past few decades. Sadly, this party cannot continue. So why have we seen this golden age? The first factor was there's been a secular decline in interest rates in the world from about 8% in the US Treasuries back in the 80s when Volcker fought inflation to what it is now, which is 1 or 2%. And the decline has been across the world. Of course, when interest rates decline, asset prices rise, right? Number two, China. China's arrival and integration into the global trading regime, the global financial regime, which is still continuing, was the single biggest redistribution of returns away from labor towards capital. That was a huge one-off factor. We are still feeling the impact of that. India will not be China. As Peter was saying, by the time India is arriving into the scene, it's already too late. Technology has taken over, and India will not follow the same path as China. So that was a one-off factor that's gone and finished. A third big factor has been the decline of corporate tax rates. You hear headlines about tax competition all the time. You've seen 0% corporate tax rates in some countries. You've seen flat tax rates in others. And this decline is very substantial. Across OECD countries, between 10 to 30% decline in corporate tax rates over the past few decades. Again, you can say, as with Trump, you can continue to cut taxes, but frankly, we're getting close to the bottom bound there, and the populist response means that there might actually be a backlash. So that is not going to happen again, right? And the demographic dividend. There was a time when the baby boomers were coming into the markets, the absolute number of workers in the OECD countries was actually rising. That party is over. We have actually started shrinking. Half of the growth that you saw in Europe came from productivity increases, and the other half came from an actual increase in the number of workers. That is not going to happen again. So this golden era of the great big returns that we saw for our institutional investors is now gone. If anything, at least some of these factors will go into reverse. The demographic decline may start acting as a drag. Interest rates have started to rise. Corporate tax rates in some countries facing populism might actually start rising again. And you are going to face a very bleak prospect of returns. all long-term forecasts of the kinds of, or returns on the kinds of investments that our funds have are of the order of 2 or 3% real for the foreseeable long-term future. US pension funds still, in their calculations, factor in a long-term return of 7.5% for the foreseeable future. That will never happen. Not for, maybe for 2 years, maybe even for 5, but definitely not for 10 and 20. So why is this terrible bad news for all of us in this room, including especially those who have pensions and maybe close to retirement age? Why is this good news? Well, it's good news because for every country which is facing a demographic decline, there is at least one country out there that is facing a demographic dividend. For at least one country that is close to the technological frontier, where the prospects for new, huge productivity gains are very, very limited, there is at least one country, as Peter pointed out, that has leapfrogging opportunities, that is not going to make, as India didn't, those wasteful investments in landlines, those wasteful investments in fossil fuel plants, because they're arriving into development at a time that technology has moved on. For every country that is facing rising political risk, there are other countries out there where political risk has stabilized. For every country that has an unorthodox monetary policy in the EU, for example, or in the developed world, in Japan, for example, there is a country out there that is facing textbook economic policy. For every country with rising fiscal deficits, there's a country out there that has stabilized its fiscal situation. The opportunities for where future global growth is going to come from has shifted decisively, has shifted dramatically, and that is very clear. And that is why it is good news for the people in this room, because that is your world. That is not the world inhabited thus far by the likes of PGGM, ABP, the Norwegian Sovereign Wealth Fund, and others. If you look at their present portfolios, the news is very clear. With their present portfolios, 80 to 85% are invested in OECD countries. 80 to 85% are invested in listed stocks and bonds, the return prospects of which are very poor. There is only one direction of movement, which is into unlisted assets, which is into assets that are in countries with different growth prospects, that are facing different kinds of risk factors, and even a small movement, a movement of 1%, 5% allocation of assets away from $80 trillion is a huge amount of money for the kind of work that we do. So the question then is, here I am, a fund, such as the Norwegian Sovereign Wealth Fund, where each employee, on average, is responsible for $1 to $2 billion of investment. Who do I go and seek to find these promising opportunities I keep reading about in the newspapers in solar, off-grid solar in Kenya, right? I'm calling FMO. I'm calling the development finance institutions. What is a group of institutions out there that has a long, profitable track record, that is in line with the zeitgeist Peter was talking about, that does impact, that delivers an impact, that is sustainable, that follows good standards and policies on ESG and delivers on exactly the kind of priorities that everybody is talking about, that many of the policy holders of these pension funds are pressuring them to look into. It is exactly the kind of work that DFIs do. They have long, profitable track record, very good on impact, that is a fundamental part of your purpose, very good on enhancing standards, building local capacity. You've got a local presence in these countries, you've got partners, you've got institutional memory. This is a marriage made in heaven. So where, one might say, is the problem? On paper, it's absolutely fantastic. Now let's talk some numbers. How does one connect someone from the Norwegian Sovereign Wealth Fund who is looking to deploy 1 or 2 billion with $150,000 opportunity in a Somali refugee camp, in a Kenyan refugee camp? How many of those opportunities would be needed? How many people do I need to put together those opportunities into something that starts to look interesting for someone my size? The problem lies there. And so does the solution. Not only do many of these people in these institutional investors not have the capacity to go seek out these investments, they don't even have the capacity to talk to people who have the capacity. That is the scaling challenge that we have. The fact of the matter is, the theoretical case is clear, the case from generating returns is clear, the case for enhancing diversification is clear, the case for impact is clear. What is unclear is how to go from the so-called billions to trillions. Here, I fear, we have gotten ahead of ourselves. If you look at the breathless rhetoric, including, for example, from the likes of the Blended Finance Task Force, they talk about take a project, put blending in, leverage it 3 times, leverage it 3 times more at the project level, and lo and behold, the $1 trillion funding gap is met. And the phrase, DFI models are easily scalable, is repeated again and again and again in development policy papers from development agencies, in the breathless rhetoric. And as any of us who's ever actually worked in a DFI know, that is absolutely not true. The DFI model is bottom up. You first look at profitable opportunities on the ground. And then you are able to do due diligence. It's manpower intensive. On average, one DFI employee is able to maybe, with good due diligence, do 2 or 3, maybe 5 projects a year, many of them of $100,000, some of them 1 or 2 million, 5 million. And to get that together, even with the number of people you have working in FMO, into something that suddenly looks interesting for Allianz, which wants to deploy $500 million by tomorrow, is a very, very big challenge. The DFI model is not easily scalable. So the question is, what should we be doing? What should all of the actors in this landscape be doing differently to turn what is a promising theoretical case? The lie of the land is very clear, the secular trend is very clear, how to turn that into a realistic opportunity without getting carried away with the rhetoric and start to believe in our own exaggerated claims. That is the big challenge, right? So let's take some examples. It's an easy way of trying to understand. So it's very easy to lose money, right? I mean, if you want me to give away $1 million, I can give it away in hundreds of thousands of ways. If you want me to give away $1 million but get back at least half of that money, only lose 50%, I'm already seriously constrained in how many ways I can throw that money away, right? If you want me to only lose 10%, the number of possibilities I have to invest that money shrinks dramatically. If you actually want me to make a 10% profit on $1 million, the number of opportunities I have, for example, in a country like Kenya, is very seriously limited. We suddenly go from millions of possible ways of giving away money for free to maybe tens of ways or hundreds of ways of making a 10% profit. And this is one of the big things that we are missing out in the present discussion on blending. Blending somehow, the way it is spoken about, assumes that you can take a fundamentally loss-making proposition and turn it with blending into an investable opportunity. Blending cannot do that. Nobody can do that. You can take a marginal project. You can take a project that might, looking at cash flows, be losing 10% of the money, with some human capacity, with some technological help, with improving some standards, with a tiny bit of grant to get them over the first 3 or 4 years with some blending. You can turn a minus 10% cash flow project into a plus 10% cash flow project. But you cannot make a fundamentally unviable proposition into something that is sustainable. And if you try and do it, and therein lies the problem, if we exaggerate too much this promise of blending, if we try and push public money out really quickly to generate large headline numbers for investments because we are trying to scale up from billions to trillions in a time constraint, we are going to have a day of reckoning. The Financial Times 3 or 4 or 5 years from now will be dominated by examples of wasted public money where scarce public resources were given away to funds, where 3 or 4 sources of subsidy were given to exactly the same fund, invested in unviable projects which don't work. And even if you didn't actually care about those headlines and the backlash that this will generate, which will hurt our industry, which will hurt the SDGs that we are trying to meet desperately, you have to care about your fundamental business model and the fact that you live for impact. All the impact in the form of jobs or tax paid or productivity enhancement that you can get from a project will disappear if the project itself fails. And this is the fundamental core proposition of the DFI model, right? That you have to have profitability. Profitability is a precondition to lasting sustainable impact. Temporary subsidies are necessary. They can be very helpful, but as long as you see a clear exit, 5 years, maybe 10 years down the line, but not a permanent subsidy. The other big problem with this debate is by over-promising, risk distorting and diverting what is a scarce amount of ODA money away from basic vaccines, public health care provision, education, etc., which are very, very important and long-term drivers of productivity, into unviable projects which will blow up in our face. If we had unlimited amounts of aid money, then of course one might do that, but we don't. And for every dollar invested in blending, that has to come from some other important use of aid money that may be equally important or even much more so. So, what do we do? What is the way forward? Well, let's take an honest look at ourselves. As we presently stand, DFI models are not designed to scale, but maybe we can work on that. The first thing would be to think of our identity, a change in identity away from us thinking of ourselves as providers of capital, fundamentally as providers of capital, into rethinking of ourselves as intermediaries for capital. Let's do that. This means that the incentive systems for portfolio managers within DFIs, that everybody within the DFI decision-making chain needs to think, how can we maximize the throughput of the money that is being delivered to these countries of our destination without compromising on impact and quality and due diligence? Maybe if you have a successful performing portfolio, maybe put it together, securitize it, maybe sell it off. Once projects start performing, don't hold on to them. There is a tendency, and this is also the incentive structure, that every time there's a successful cash-generating project, you of course want to hold on to it because DFI models are based on implicit cross-subsidy in the portfolio. But maybe we should start thinking differently. Maybe we should actually start compensating. This is controversial at a time that DFIs have been forced to contain salaries, which, for example, in places like CDC, where it came under a lot of controversy. But if you are going to have DFO portfolio managers working alongside mobilized capital from private equity, from asset owners, who are getting 2 or 3 times the compensation that you are at DFIs, that can be very demotivating. We need to think, what will we need to do differently in order to be able to churn this significant amount of capital through our structures, through our balance sheet, using our manpower, our institutional memory, our human capacity, and local partners. That is the big, big challenge for DFIs. At the very least, it does mean a significant increase in manpower. And if there are any donors in this room who are looking either to directly give away blended finance facilities or thinking of deploying them through the DFIs, please deploy them through the DFIs. They alone had the bottom-up experience of understanding what it actually takes to evaluate a project, whether it's a project with minus 10% return with the potential to make a profit, or whether it's a project that's fundamentally profitable, or whether it's one that's unviable. You do not have the expertise. Don't throw away scarce public money. Perhaps the single best thing we can be doing is to significantly expand the number of people who work for DFIs. And that is, to my mind, the most important next step, to try and go from billions to the hundreds of billions, using DFIs, leveraging their strengths. I'm not sure DFIs will be able to deliver the $1 trillion missing dollars that everybody is saying that they will be able to. But one step at a time. Thank you very much.